They are some of the most powerful and honestly least understood institutions in the entire world. We're talking about central banks. They don't really print money the way you might think, but wow, their decisions can make your mortgage cheaper, your savings worth less, and can literally pull the global economy back from the brink of total collapse. So let's dive in and really demystify the world of central banks.
First up, let's look at the central bank in its most dramatic role. I'm talking about when the whole financial house is on fire, they're the first ones on the scene.
So what starts that fire? Well, it often begins when the value of the stuff people own, stocks, bonds, houses, suddenly just plummets. When everybody realizes their assets are worth way less than they thought, all that confidence just, poof, it evaporates. And that panic can spread like wildfire.
And this is where the central bank has to step in as the lender of last resort. See, when banks get too scared to lend to each other, the whole system just freezes up. The central bank provides that emergency cash, a financial lifeline, really, to stop a liquidity crunch from becoming a catastrophic failure of the entire system. They are the ultimate backstop.
Okay, but fighting fires isn't their only job. Most of the time, central banks are doing something way more subtle. They're trying to steer the economy, keeping it running smoothly without overheating or stalling out. And the main tool they use for this is the policy interest rate. Honestly, the best way to think about it is like this. Lowering interest rates is like hitting the gas. It encourages everyone to borrow and spend. Raising rates? That's slamming on the brakes. It makes saving more attractive and cools everything down.
The core logic here is this constant balancing act. Central banks are always comparing their policy rate to this theoretical natural rate of interest. If they set their rate above that natural level, you're going to want to save, and that cools the economy down. But if they set it below that level, hey, it's cheap to borrow and invest, and that heats things up. It's their number one way of controlling the economic temperature.
But how does a single rate change in some boardroom actually reach your wallet? Well, it's not a straight line. It's more like a powerful ripple effect. First, it directly changes what you pay for a car loan or a mortgage. Then, it messes with the exchange rate, making foreign stuff cheaper or more expensive. It can boost or tank stock and housing prices, which, makes people feel richer or poorer and changes how they spend. It even impacts the financial health of big companies and banks, which affects how much they're willing to lend and invest in the first place. It's all connected.
Now, for decades, that was the standard playbook. It worked pretty well. But after the 2008 financial crisis, central bankers had to get, really creative. And that's when we entered what we now call the unconventional era. So here was the big problem they faced. They had already hit the gas pedal so hard that interest rates were basically at zero. They couldn't cut them any further, but the economy was still sputtering. So what on earth do you do when your most trusted tool just stops working? Well, you turn to something called quantitative easing, or QE. Now, in simple terms, this is where the central bank basically creates new digital money to buy assets like government bonds directly from commercial banks. The whole goal is to pump cash directly into the financial system, push down those long-term interest rates, and get banks lending again. And this slide right here shows you exactly how it works. On the asset side of their books, the central bank buys up a ton of government bonds. To pay for them, it creates brand new digital money on the liability side, crediting commercial banks with huge new reserves. And the result? The central bank's balance sheet just balloons in size. It's pretty wild.
Another one of these unconventional tools was even more shocking, frankly. Negative interest rates. Yes, you heard that right. It literally means commercial banks were charged money just to park their extra cash at the central bank. The idea was to give them a really powerful shove to lend that money out instead of just sitting on it.
Well, look, these unconventional policies are not some magic bullet. They're super controversial. Critics argue that keeping rates this low for this long just crushes savers, right? It encourages super risky behavior that can create new asset bubbles. And it can keep these unproductive zombie companies alive on cheap debt, which ultimately just drags down the whole economy.
And all this kind of brings us to the next great frontier, the next big challenge for central banks, figuring out how to navigate the rise of digital money.
So let's talk about central bank digital currencies, or CBDCs. The simplest way to think of it is as a digital version of cash. See, unlike the money in your bank account right now, which is a liability of a private commercial bank, a CBDC would be a direct claim on the central bank itself.
And this right here, this is the absolute key difference.
The money in your checking account today, it's basically an IOU from your bank. A CBDC, on the other hand, would be a direct IOU from the central bank, just like a physical dollar bill is, but in a purely digital form.
So why would we do this? Well, the people who are for it argue that CBDCs could be way more efficient and cheaper than printing and moving physical cash around. And crucially, they would offer all of us a genuinely risk-free digital asset that could actually reduce the power of those too big-to-fail banks and maybe make the whole financial system a bit more stable.
However, and this is a big however, the risks are pretty huge. I mean, what if everybody decided to move their money from their regular bank accounts into these new, super safe CBDCs? You could see a massive outflow of funds from the banking system. This disintermediation, as they call it, would basically starve banks of a cheap source of funding, and that could really hurt their ability to make loans and end up tightening credit for the whole economy.
So, from crisis firefighter to economic pilot to digital pioneer, you can see the role of the central bank is always changing, always evolving. Let's try and pull all of this together.
When you really boil it down, central banking is a perpetual tightrope walk. If you intervene to prevent a crisis, you might encourage more risky behavior down the line. If you lower interest rates to boost growth, you might create dangerous asset bubbles. And if you innovate with digital currency, you could destabilize the very banking system you're trying to protect. Every single tool they have involves a major trade-off.
And this brings us to the final and maybe most crucial question for our future. The very nature of money itself is changing. As we move away from physical cash and private bank deposits and toward all these new digital forms, the question of who creates, who controls, and who guarantees our money, well, it becomes more important than ever. It's a question that is absolutely going to define the next century of finance.